All right, and a good afternoon, or excuse me, good evening to everybody out there as we get set to begin our webinar here on the navigating the cash market. We'll get started here very shortly. Let me just introduce myself. My name is Austin Schroeder. I hope you can see me on your, or I'm sharing my webcam here, so uh, I have, sorry about that. I worked for Brugge Marketing for a little over almost 5 years here. So we're going to get started off here. I'm going to share with you a little bit about the cash market and kind of how to navigate some obstacles and some just things you might want to know or learn about the cash market and how to, I guess, get through it. So this is part 2 of the series, and we'll get started off here in a second. All right, so you all can see my screen. I'm going to start the presentation here. All right. So navigating the cash market. This is what this entire evening will be about here. Should keep it fairly short, but we're going to go through some of the cash market things, as we said, and then kind of just go over how to get through things here. First, we got to start off with a disclaimer here. There is a substantial risk of loss in futures and options trading. Of course, we're not talking much about futures and options trading here tonight, just mainly the cash market. But we also have to give you this as well. Such trading is not appropriate for all individuals or entities. Past performance is not necessarily indicative of future results. News may not result in the expected price change as known. News is often built into prices via expectations. And this presentation is not to be seen as an endorsement of futures and options trading versus other hedging or marketing techniques. If you kind of want to learn more about hedging, we'll get or futures and options trading, we'll get kind of more into that next week via our marketing, or excuse me, our hedging and options webinars. All right, first, let's get started off with kind of understanding what the cash market is. So selling cash is how you physically sell your commodity, right? So it's selling your cash product, whether that be corn, beans, wheat, cattle, hog, whatever, cotton. It's how you physically sell and get cash money for your grains or for your commodity, right? So there's obviously different options when talking about the cash market. You can sell in the spot market, which is basically selling and getting today's price. You might say, call the elevator and say, hey, I'm going to deliver grain this week, and sell in the spot market. So that's basically getting today's price. Or there's also a set in the cash market where you can forward contract. That is basically, a lot of you probably know, but it allows the buyer and the seller to set a specific price for a specific delivery date in the future, right? So say I want to forward contract 5,000 bushels of corn for next March. I would sign a forward contract with a seller, whether it be a feedlot, ethanol plant, co-op, whatever you're going through. That's what the forward contract process is. What you do in terms of selling spot, forward contracting, that kind of depends on your situation. We'll get into it. A lot of guys do both, but what you do depends on kind of your situation and how your farm or operation works here. Okay, so getting into it, I'm going to kind of progressively go through a chronological order of your mindset when thinking about marketing your cash grain. So first, we're going to start out with, should I forward contract before harvest, right? So one thing about forward contracts, it doesn't have to be you're selling grain now, or excuse me, you're selling grain in May, June, or July for harvest delivery. It can also be selling grain. You can sell it now for March delivery or so on and so forth, right? So, but this example, we're going to look at selling forward contracting before harvest, right? So this is going to be, March, April, May time period, whatever, any time before harvest, should I forward contract? There are risks associated with this, as with anything. Price could go higher. That's a very common thought. Should I sell or should I hold on to it? Prices could always go higher. Conversely, prices can always go lower. Also, another risk associated with this is that you don't have the production. For some reason, you might have gotten hailed out. You might have gotten a drought that unexpectedly came through. You might have had some green snap from some winds. Something happened to where you don't have the production, right? So you can't meet that forward contract. You're going to be facing a penalty. You're going to have to buy out that contract, etc. Well, there are some caveats put in place, such as crop insurance, that will help cover some of those costs associated if you do forward contract and don't have the production. There's always kind of those caveats obviously out there if you have them. So there are risks associated with it if you don't have the production, but there's also kind of ways you can get out of it. Positives in terms of forward contracting, you can basically sell where you can lock in a profit. Now that is assumed that prices are good enough to where, or whenever, that they're high enough to where you are going to lock in a profit if you do sell your cash grain or forward contract, right? So that is obviously a positive. You can lock in an assumed profit. Heaven forbid prices drop $1 after harvest, after you physically have the grain on hand. Another positive about forward contracting, it spreads the price risk out, right? So instead of waiting to harvest and knowing you have the production to sell all of your grain or whatnot, however much you want to sell at a certain period of time, it spreads the price risk out, because if you get higher prices in the spring and lower prices in the fall, it helps kind of spread out that price risk. Also, that kind of fits in with our 3-bucket strategy, which is kind of what we at Brugler kind of follow. We'll get more into that later here as we move on. All right. So here's an example of why or where forward contracting is probably very beneficial to a producer here, right? So I'm gonna make a little drawing here, right? So if you look at this right here, this is the average. This dotted line here is the average for December corn futures, right? So if you're forward contracting for harvest delivery, most of the time, unless you might live down in a very, very southern tip of Texas or something, where you might be able to market off the September contract, you're marketing your new crop forward contracting off of the December contract here, right? So this is basically taking the high for each month for December corn and plotting it on a graph. So this is basically forward contracting. So this would be a year out for December contract, Jan, Feb, so on and so forth. Well, if you look at this dotted line here, the box that I drew, you can see that May, June, July are very are highly correlated with higher prices in terms of price new crop December throughout the year. As you kind of get here into the later months, August, September, October, into harvest, those highs kind of drop off. Last year is a good example of why you would want to forward contract. We got up in the $6 range here for much of basically May through July last year for December corn. So it's a very good example of why you would probably want to consider forward contracting. Also, just throw this one out here too. During 2020, during COVID, we kind of had the exact opposite. Prices were basically inverted of what they did last year, or this in 2021. So obviously, like you said, there are risks associated with forward contracting. If you would have forward contracted in May, you would have basically sold at the lowest high for the year for forward contracting. So obviously there's always a equal and opposite reaction to, or that physics saying here. All right, let's get on to the next slide here. Okay, so we talked a little bit about forward contracts, and that was mainly geared towards kind of selling in the basically once you started planning a time frame to leading up to harvest. But what about year ahead sales? So this would be basically time frame of October, basically harvest, year out for harvest, right? So you're talking October, November time frames. Is it a good idea to sell basically a year out? One thing that it does, and especially this year is a good example, it protects against your input costs that are already getting pretty high, right? If you're talking fertilizer costs, they're maybe not now, but a few weeks ago were up near record or at record high prices for fertilizer. So if you have those high fertilizer costs, you need to be able to sell high December futures, December corn futures for next year. We're rallying at that same time to kind of offset those seed costs or to limit, I guess, anybody's opinion, or basically trying to limit producers next year from switching all to beans. There was a little bit of shifting in the soy corn ratio that basically corn got a little bit more, corn got higher price versus soybeans. So there was a little bit of market mechanisms trying to incentivize producers from shifting all their production away from beans. Well, what that did was that allowed for higher corn prices to be able to lock in those higher corn prices and protect against the higher fertilizer costs, right? You got seed costs, a lot of guys will buy seed, in November, December time frame to lock in a little bit cheaper seed rates. So if you got input costs to cover, selling a year out does help cover those costs. Obviously, if you're worried about next year's price being lower, i.e. if this year wasn't necessarily a short crop, it was just a tight stocks year, if you're worried that we're going to have all these higher prices are going to basically incentivize more production next year, basically giving us what we call a short crop long tail, where we have booming prices, and then the next few years or months or years are giving us a what's called a long tail, but basically a few years of lower prices and smaller range of prices. They're giving you less incentive to lock in those sales. So it does help to protect against that, hypothetically, if we would have a long tail next year. And also, it obviously spreads out the price risk. Anytime you can spread out the price risk, it's overall better for you. All right, so now we've moved to, you have the grain, now what? So you've harvested your corn or beans or wheat, whatever it is, you have it, now what? Obviously, your first step is probably going to be to deliver to wherever what was forward contracted for harvest delivery. That's going to be your first step. Your second step is thinking, okay, do I have storage? Do I have grain bins? All right, do I fill it up? Do I find more? Do I not fill it up? Am I getting a good price at harvest? Etc. Right? So you have to think about, okay, what's my next step? You can also deliver your grain to the elevator or whatever. A lot of times the elevators will let you deliver and take free storage for 15 days, 30 days, whatever it may be. You can sell it then, or you can pay storage on those bushels that you have in the elevator. Right, so that's kind of some things that you can do once you have harvested your grain. Obviously, like I said, your first step is going to be to deliver that forward contract. You want to make sure to fill that contract so you're not getting penalized for not filling the contract, so on and so forth. So we'll kind of go over some of these steps and what's beneficial and so on and so forth here as we move on. Okay, so when you think about what to do, right? There's a lot that goes into it. You're kind of in a 3D chess type of a scenario, right? You have three things going on. You have price, you have your base order. So price is basically futures price. Price, it can vary, over time. It's going to go higher, go lower. Price is unpredictable, right? Basis, you obviously have your basis. That's it's going to depend on where you deliver. It tends to, now not always, but it tends to improve throughout the marketing year as we get less supply. It kind of helps to spread out what we call, it's the cash market's way of kind of dealing with helping to incentivize carry, what we call, obviously. And then the other scenario or the issue we have to deal with is time, right? Time is money, right? So you have to pay money if you store it. If you're paying for time if you store it, and also you have interest associated with loans or whatnot if you decide to store it and not pay off any debt or whatnot. You're also you're going to be there's time is money associated with the interest aspect as well. You can also look at it. Are you playing a 4D chess game? You got spreads. Is there a carry? Is there an inverse in the futures market? Is the market telling you to sell? Is the market telling you to hold on to your grain because they don't want it now? So there's a lot that goes into this. All right. So when talking about carry, what we mean is there's a cost associated with carrying your grain. You obviously have storage. That's the number one thing a lot of guys deal with. So obviously you have to pay for grain bins. They're not free. Well, in some cases, most cases, they're not free. There was, I think, somebody had some sort of a sale, or not sale, but if you sold your grain through them, they paid for your grain bins or something a few years back. But most of the time, you pay for putting up your grain bins, and they're not cheap, right? There's costs associated with baggers. If you just have a bagger that you put at the end of your field, you got to pay for the bag, you got to pay for the equipment for it. Storage also, if you go to the elevator, you have to pay the elevator storage. So there are costs associated with storage. You also have insurance costs. You got to pay insurance on those grain bins, right? That's something you don't want to go without. Financing is there, like I said, is there something that's you're losing interest on that, okay, I need to associate that with my cost of carry. And then additional transportation. So this is basically, okay, I'm going from the field to the grain bin, and then I'm going to go from the grain bin to the end destination, wherever that is, right? So am I adding miles doing that, right? Is it a straight shot of 7 miles from the field to the feedlot? But if I go store the grain, is there an extra 3 or 4 miles associated with that? There's additional transportation costs. You got to think about that as well. Okay, so moving on from the carry, when to sell. So we're going to kind of get into not only cost of carry, but what price does that may incentivize that. So this is the average corn futures price based off of USDA data throughout the entire marketing year for which, what is going on? For the marketing year, right? So you got September through August. That's the typical marketing year for corn. What we have here is the average monthly price for each year based off that. As you can see here, prices tend to kind of get a little bit higher as we hold on to this grain, coming up, bouncing from a harvest low down in here. This is the long-term averages dotted line. Obviously, if you look at the 1920 marketing year, was not a good year to store your grain, and we'll kind of get into that in a second, because prices basically peaked at harvest and went down. Last year, the exact opposite. Prices bottomed at harvest. We basically went linear up from there. So when you're thinking about when to sell, you kind of got to think about this as well. Okay, to store or not to store? That's the main question here. Does it pay to store? In 1920 marketing year, where we dealt with the COVID issues, it really didn't pay to store. This blue line is the average monthly marketing. So this is 1 is September, 2 is October, etc. 12 is August, right? So this is your entire marketing year. This is the basically percent of corn marketed throughout that marketing year for each month among U.S. producers. And this, so basically we take this September price, and we take the prices based off that for each subsequent month. But we also took we added the accrued interest and storage that is associated with that, right? So basically this linear line here is how much you're paying for your grain. So if 380 was what the price was by the time at harvest, right? You're essentially, if you hold it for 12 months, you essentially would be paying an extra 30, roughly 30 cents on that. So it rises. It's about 2 to 3 cents a month or so per bushel. But obviously, anytime the green line is below the red line, it did not pay to carry or store your grain. And 1920 was a year that did not. However, look at last year, the exact same price, or excuse me, the exact same graph here, but as this is your accrued interest and carry. If you held your grain clear out to July, August timeframe, you made a lot of money on that grain, right? So that is not only had a factor of futures prices rallying, but also the basis was getting very strong here in these last months. So it did pay to carry your grain last year. So every year is different. This is the average of all the years, I think, like a 20-year average or so that we've kind of brought. So basically, it doesn't pay to sell your grain in September through September, October, November, December. But once we get into January, February, March, it does. So one thing we do notice as you get towards July, August timeframe, it really doesn't pay. Based off the long-term average, it doesn't pay as much to hold your grain that long. But based off the average, it does pay to store if you're just playing the average game here. Okay, next thing you got to think about is their carry in the market, and this is talking futures market, right? Markets typically will build carry into the market. They're trying to, I guess, if you look at, I'd said the price of each contract build into succession, they get higher priced as you go on. The market is basically trying to get you to store your grain if there is carry in the market. They don't want all your grain in harvest. They don't want it all at one point. They're basically paying you to hold on to your grain for an X period of time. A good scenario here is, or somewhat good scenario here is soybeans. There is a little bit of carry in this market. We got a 4-cent carry from Jan to March, another 9 cents from March to May, and then another 7 cents from May to July. Obviously, going to August, there's no carry past that. But the market is basically saying, store your grain a little bit, and we'll give you a little bit extra money. Now, on the conversely, there's also what we call inverted markets. So that is basically the exact opposite. They don't happen a lot. We basically, this market is inverted. Inverses are infinite is what they call it. But if you look at the spring wheat prices here, spring wheat for nearby December is 34 cents over March. And then there's another 11 cents over May, and then another basically 33 cents from May to July. So basically the market's saying, we want your grain and we want it now. Prices, they basically are saying, we don't want you to store it, we want your grain now. Now, when that happens, it doesn't always, the market, that's what the market is telling you to do, but what the market is telling you to do isn't always, beneficial for you. So, just because there's an inverse in the market instead of a carry doesn't mean you want to sell all your grain at harvest. Like I said, you got to look at other factors, including, basis is one you got to look at. And we, tend to say inverses are infinite, which means it can go on for a while. The market's, if you hold on to your grain, the market's gonna continue, or gonna add to that inverse a little bit longer here. So it doesn't always pay to sell in an inverted market. So just because the market is inverted and they're giving you current higher prices now, doesn't mean it always pays to go ahead and get rid of it. Your grain anyways. All right, so now talking about basis. Basis is basically, if you don't know, the difference between cash and futures price. So you have your cash price minus your futures. That's going to be your basis, right? So if your cash price is $5.75 and the futures price is $5.85, your basis is minus 10 cents. The tendency for basis is to get better over time. If you look at these averages here, these dotted lines, they tend to improve over time. In 1920, again, we would keep referring to that, they did not like you storing your grain for very long. They wanted you to get rid of it in terms of the local markets. This is the national cash average, mind you. And last year, they definitely wanted you to keep storing your grain. You look at that basis, and the national average basis was 80 cents over for corn. Pretty good basis last year, or in 2021. As we get towards this marketing year, it kind of weakened a little bit. And just to let you know how we refer to basis, if it's a weak basis, it's basically, in terms of, okay, so in 1920 marketing year, this brownish looking line, basis got weaker, right? It went further away from zero, or it went, it got further negative, right? Last year, basis got stronger throughout the marketing year. It was really strong. Typically, when basis is your indicators of your supply, your local supply. Strong basis, typically you have tighter stocks. A weaker basis, you have a larger supply or looser stocks. So when you're looking at basis, a lot of it is localized when you're talking about how you're looking at different basis. Central Nebraska might be 10-20 cents under board. You go out to Illinois, it might be 10-15 overboard, over the futures board price. So it just kind of varies on what you have in terms of a terminal. For, do you have a lot of feed yards around your farm? Do you have ethanol plants? Do you have export terminals? Stuff like that. So as you get closer to, a lot of times, those export terminals, you probably do have a little bit better basis as you're shipped down the river, like in Illinois along the river. If you're going up to North Dakota, they have a little bit weaker basis, and we'll kind of get into this, I think, a little bit more on the next, next couple slides. Yeah. And we'll kind of get into this a little bit more, but let's get in on the beans as well for the basis. So bean basis got pretty crazy last year. It kind of bounced around, got really strong here, leading up into the May time period. We thought we were running out of beans. Crush margins were still good. A lot of guys were crushing beans, or a lot of bean refiners were crushing beans, and we were still having a pretty good export program, back here, kind of tightened those stocks and made this kind of happen. But what happened was, down in here, we had the crushers kind of priced out some of their own demand, and basis got a little bit weaker as we got a little bit further along. And then also late in here, we did have a hurricane in New Orleans, hit New Orleans, that did shut down some export terminals and kind of ruin a little bit of the export market. So basis does really rely a lot of times on your demand and your ability to get through the beans, right, or corn or whatever it is, right? So if you have a really strong demand, basis tends to be higher. If you have weak demand, it tends to be a little bit weaker. All right, and also basis is regional. That's kind of what I was referring to a little bit prior to. If you look out here, you can tell down in basically western Kansas, southwest Nebraska here, they must not have a lot of corn. This is the corn basis map for the most of the U.S. here. They must not have a lot of corn down here. You kind of get over into, I think this is Wisconsin, up in North Dakota. Their basis is a little bit weaker here. They must have had probably had pretty decent production up here. But getting on into basis is regional. Typically up here in North Dakota, they don't have as many ethanol plants. They don't have as many feedlots or anything like that. So they do tend to have a weaker basis just annually based off that. Also, if they do need to, in terms of exports, they don't have much, they don't have any rivers they can ship it down. So they're a lot of times relying on rails to get it to a port, or maybe, they might be railing their corn down to Mexico or up to Canada or down over to the PNW for their export market. So basis does factor that in, right? So if you have to truck your grain further and it costs more, then you're probably going to get a weaker or lower cash price versus the board, based off if you're down here along the river, right? You can put corn here on a barge and ship it down the Mississippi, down to New Orleans, and put it on a vessel, and it can be out in a short period of time, and it doesn't cost a lot. Cost to get it to an export terminal up here is a little bit more, right? And you can kind of see it's very localized. Some spots have better basis just because they have more feedlots, more hog facilities, whether whatever it is, they have a little bit more demand, localized demand that will compete for their grain. Think of it as a competition. We got an ethanol plant and a feedlot bidding for corn. They're probably going to bid up prices to get that farmer to sell their grain. So basis is very a regional thing, and it's not always like this. Down here in Kansas, basis is so strong, mainly because they had a good sorghum shipping program for exports, and wheat prices are extremely high, so nobody's feeding wheat right now, and they apparently just didn't have the production here either. So it kind of depends. It can vary from year to year, but typically, your basis is always going to be very regional. All right, so let's get on to marketing strategies now that we kind of understand the carry, the market, and the basis factors here. Let's kind of get into some marketing strategies. So what we at Brugler like to do, and that's kind of one of our main strategies here, is what's called a 3 buckets strategy. So we have 3 different basically time periods where we like to, and it can vary year by year. It doesn't always have to stick by this, but we like to have a third of your crop sold by planting. It can be it doesn't have to be a third. It can be 25%. It can be 40% depending on the year and what prices are doing. But that's what we call a make me do it sale. The second third is sold by harvest. That's kind of your comfort level. Remembering back to those high periods for corn, May, June, July are typically the higher time periods for forward contracting. December corn futures. So, that's kind of your comfort level, getting another third sold by roughly around harvest. So, and like I said, it doesn't always have to be, the exact third amounts. It can be just, one bucket can be a little heavier than the other, I guess. And finally, the last third is stored and sold basically post harvest. You're merchandising this grain, right? So you're trying to play the carry, play um, you're trying to add carry into your grain, and so on and so forth. So like I said, it doesn't always have to be a third, doesn't have to be split into a thirds, but this is just kind of a general strategy that we do follow. Oops, excuse me. The next one is kind of a scale up, right? So look at this graph, right, or this chart, and you can kind of see, okay, so here's your cost production, and here's basically your bottom line. Here's your break-even cost. And it doesn't have to be 20%. It can be a different percent, but just an example here. Just scale up. So you sell X number of percent at this price level, and you just scale up as the prices continue to rally. You sell another 5, 10, 20%, whatever you want to do. And once we get higher, or as high as it could possibly go, you're basically sold out. So that's another strategy that you can follow. If you don't want to try and get everything, if you don't want to be completely sold out, but you kind of want to, you do think these are good, attractive prices, and you kind of want to get rid of some grain, you can, use this scale up method and kind of sell every 10, 20 cent increments higher here, depending on obviously the commodity. Also, we have another strategy here, what's called the inverted pyramid. So basically, so here's lower prices, here's higher prices, right? You're selling as let me get a pen here, as you get higher prices, you're selling larger quantities here. So, right, so you're selling 10% at these lower price levels, then you're selling another 20% at higher price levels, and then you get up to this next level, you sell 30% and then 40%. Right? It doesn't always have to be those percentages, but just to give an example here, as you basically get higher prices here, you're selling more quantity, larger quantities, right? All right. Next slide. All right, and this is one that we like to follow. We actually, this is kind of these price and probabilities are proprietary to Brugler, but what these do is this is another marketing strategy that we have. We have basically, there's always a contract that we are watching, right? So we have the December Kansas City wheat chart and the December cotton chart here, just for examples of when is probably a good spot to sell. So what we do here is we take number, it's a very thorough process to explain, but we basically run a bunch of regression models off of in this period is a June through December time period. We take the high for that time period, we take the low, and we take the June 1 start price, and then we take the December 1 close, and we run a bunch of regressions, and we get these, what are these numbers here. So we get and we have a standard, a regression high. We have a PPI, that's an inflation adjusted high. So we're adjusting for inflation here. And we also we split it between up years and down years. Up year would be where prices on December 1 are higher than on June 1. And a down year is obviously the exact opposite. But what these do is these give you good prices to sell for, right? So obviously the market was kind of rallying here and stopped right around our regression and PPI adjusted best fit highs. These are based off of 1 standard deviations above those highs, right? So basically in 66% of the years, the prices will get this high. If you go to a 2 standard deviation, that's 95% of all years will get that high. Basically what this means is you have 20-to-1 odds that prices will not go higher than this. And it seemed to work pretty well here. So if you followed this strategy, you might have sold a little bit of cotton here, and then you might have sold a little bit more, quite a bit more probably cotton at these price levels as well. Basically, it gives you an example or a price or a number to where, how far prices can go. And also, mind you, they can go down as well. We've seen rallying prices here. Prices can also head the other way. So don't take this as they're always going to get to the best fit highs. They can also hit these best fit lows. But these are something that we do have at Brugler Marketing that a lot of our clients do love, and you know, there's some guys are very religious at you know, if they get up here, they're selling quite a bit of their crop if we get to these +2 standard deviation highs, because prices typically don't go above that. Anyway, so that's kind of another marketing strategy that we do offer at Brugler. All right, so switching from ways you can market to what kind of contracts are out there, right? So when you're talking about cash marketing, there's so many things you can do. First, you know, a lot of guys will do an HTA, which is called hedge to arrive. Basically, it's kind of a forward contract in a sense, but you're not setting your basis, right? So you're setting the futures price. It's essentially a hedge. You're setting a futures price, but not your basis. The only difference between this and a hedge is the elevator or whomever is putting up margin for you instead of you having to do that yourself. Now, there may be a fee associated with that, but you're essentially letting the elevator or whatever put up the margin. So if, you know, prices, you know, there is, you know, if price risk, if prices do go down, or excuse me, if prices do go up, there's more than likely going to be a margin call on that. You don't have to put that up, the elevator does. Right, so essentially it's a short futures position that the elevator is putting up. Like I say, the bad thing here is you're not setting in your basis. So typically, a lot of times what happen is a lot of guys will schedule or use an HTA for a certain period of time, and if there's, you know, let's just say an elevator has 100,000 bushel on the books for March set by an HTA, what'll happen is they might say, well, you know, we really don't need the corn. We're going to kind of give you a little bit weaker basis. So there are issues there with doing an HTA. There are some services that do offer that you wouldn't have to go through a specific elevator here. You would go through someone, I believe, like Indigo has services where you can use an HTA and they'll put up the margin, but you're not set on a local, or you're not set to a destination. So you aren't as set up for that basis risk. But that is something to be aware of. That basis is not set during an HTA. Now, for a basis contract, basis is the one that's being set, right? So you're setting the basis, you're not setting the futures price. Right now, if you go back to that basis slide, we had some pretty decent basis levels on corn. You might think about using a basis contract in scenarios like that where you have a good basis, but you think that there is a scenario where basis might get weaker, but you don't want to lock in your futures price. You can do that. Now, the thing with this that is a little bit riskier than, let's say, an HTA, because these, I mean, you think these two are kind of basically opposites. HTA, you're setting your futures price, not your basis. Basis, you're setting your basis, not your futures price. One thing that is a little bit riskier with the basis contract is your price risk, right? So if futures are, let's just say here, different price levels, let's say they are 4, well, that's probably not a good example for right now, but let's just say 450 and 5, let's go $5 here, right? So here's prices right now, right? If prices do this, right? And you know, maybe saved yourself 10 cents on basis because, you know, you set your basis said, well, prices went from, you know, let's just make it even, went from $5 to 4.50, and you're out 50 cents. So net, you're out 40 cents on that contract, versus if the same scenario happened with an HTA, you have, you know, prices went from $5 to 4.50. You're going to get those $5, but you might get a 10-cent weaker basis, or you know, just use that as an example. You're going to be up a little bit better um, based off that. Now, prices can also rally, and um, you can get better price, but the price risk is a lot larger than the basis risk, right? So when you're talking 4.50 or $5, $6 corn versus a, you know, 25-cent basis, your basis risk is a lot smaller than your price risk. All right, let's get on to the next slide. All right, so what other contracts are out there? Well, you know, depending on who you're going through, there's a bunch. You know, I could spend a lot of hot air talking about how many contracts are out there, different contracts are out there, but there's, you know, there's quite a few. We're going to go over a couple here, just kind of talk over them a little bit. So you have a minimum price contract. That's kind of one we're talking about here. So a minimum price contract is where you're basically locking in a minimum price. If if price goes up, you receive a higher price, but you're locking in at least a minimum price. You're probably going to be a fee associated with this contract, but what's happening is basically the feedlot, or well, not feedlot, maybe, I don't know, whoever would be the buyer, ethanol plant or elevator, whoever, Cargill, whatnot, would be buying a put option, which is basically your price floor. We'll get into this a lot more on the hedging webinar on Monday here. But basically, you're buying a put option, which essentially gives you a price floor, and they're doing that on behalf of the seller. So basically, a minimum price contract allows you to have, lock in a minimum price, but prices can go higher, and you can receive those higher prices. Now onto a min-max price contract. Market is going, or excuse me. So what happens is there's basically kind of a, if market goes down, the price producer receives a minimum price. If the market goes up, the producer receives the maximum price. So it's basically a price range where it kind of you have this basically price range where if the price goes down, you receive the minimum price, but if the price goes up, you receive the max price. Basically what happened is the buyer, whoever it is buying a put and selling a call that gives you that said price range, and it kind of, you know, you hit whatever one, it kind of knocks you out there. On to the next one. Like I said, there's, if you're interested in some of these, talk to your local merchandiser. They can explain it a lot better and a lot clearer. But just to kind of point you out that there are so many contracts out there that are available for your use, you know, if you so wish to use them. Another one is average pricing contract. So basically what happens here is there's, you know, futures price is determined by an average price during a specific period of time. So say it's a month, you basically take the average price over that month, you know, say it's $5.75, that's what you're going to get, and then you set the basis when you deliver. And so that's kind of self-explanatory on that one. Another one that is offered a lot of times are what are called price accumulators. Basically, what happens is you have a certain number of bushels that you want to sell, and X number of bushels are sold. Basically, it's, you know, if it's 5 or 10,000 bushels over, let's just say, make it easy math, 10 days. It's usually a lot longer than that, but 10,000 bushels over 10 days, they're going to say 1,000 bushels a day are sold above the knockout price. Now, if yeah, so here's that formula. I'll just make a note here. Bushels contracted divided by the period length is how much is price per day, right? So that's kind of how you get that X number of bushels. It can be whatever. If price gets above the accumulation level, then the number of bushels sold doubles, right? So let's say, for example, I'm gonna erase and draw a chart here. So right here's the accumulation level, and here's your knockout level, right? So let's say price is doing this, it rallies, goes above here, and then it drops and just tanks, and there you go. All right, so this is your accumulation level. Just write this down, and this is your knockout level, right? Okay, so what happens when price does this? Price, you're getting basically X number of bushels are sold per day here. When it gets above here, you take those number of bushels and you multiply it by 2. So you get above that. So however many days, let's say it's above there for 3 days, you're selling double the bushels for those 3 days. Price goes down, price just tanks. Once it gets to this knockout level, pricing stops. Your contract's basically done at that point. Once you get to that knockout level. So that's just another, that's what's called a price accumulator. That, like I said, is just another of many price or contracts or that elevators or end users, whatever, have out there for you. So lots going on in terms of what is going on out there. Just kind of to make you aware, like I said, if you're interested in these types of contracts, I would definitely talk to your local merchandiser, your elevator, ethanol plant, whatever you're going through, and see what they have, what they offer. So some may offer a lot more than this, some may offer a couple of these. So talk with them and see what they have, but just so you're aware that there are several contracts out there for cash marketing. That is going to conclude the presentation here this evening for cash marketing. I guess I don't have a slide here for any questions, but if there are any questions, I will go ahead and check right now. And you guys, if you have any questions, feel free to raise your hand or whatnot, and I can kind of call on you or check your question box and see what's going on. If anybody has any questions for me, I really appreciate anybody who watched this all the way through, and we really appreciate it, taking your time out of your schedule to kind of hear us talk about cash marketing tonight. Be sure to attend next Monday's webinar on hedging. We at Brugler do quite a bit with hedging, and that's something that we kind of offer for one of our marketing services. But if you want to know a little bit more about it, don't let it's not as scary as some people say, but obviously there is a lot of risk associated with it. So take that with a grain of salt as well. But we'll kind of go over the hedging more on Monday. So if you're interested, please be sure to attend that one as well. But for this marketing or cash marketing seminar, I hope you all enjoyed it. And please feel free to reach out. Here's our office number, 402-697-3623. You can find it right here. And you can also, just here is all of our email addresses, Alan's email address, my email address, and Ryan's as well. You can reach out to us, give us a holler, ask us anything you want, market related, obviously. So please do if you have any questions. I guess with that, I will, excuse me, sorry about that. With that, I will conclude the marketing webinar this evening. Thanks for all attending and have a great evening.